So value traps, where are they today? Banks, they're value stocks. But we think they're going to be disrupted in many ways. Inverted yield curves, we think, are not just a passing phenomenon. We think they're going to stay flat to inverted, which is really difficult for banks because of innovation. And you can go back to the 50 years ended in the Roaring 20s, and you will see that yield curves were inverted more than 60% of the time, on average 100 basis points. This is a killer for net interest margins, right? And that the steepest inversions occurred during periods of strongest growth. It's the opposite of the way people are thinking now. And the reason that is because with innovation comes very rapid unit growth, and we think growth is understated in the economy. We're still operating with industrial statistics when we're in the digital age. It doesn't make any sense. So we think that real growth is understated, and productivity as well. And we think that inflation is overstated. So we might already be in a deflationary period. So the short end of the curve is responding to unit growth, very strong. The long end of the curve is responding to inflation, very low. So it makes sense. Back then, the average short rate averaged, or the short rates averaged 4.9%, long rates 3.9%. And we do think if we're right about what's going on with innovation and the exponential growth opportunities ahead here, that those kinds of interest rates will return. So that will be negative for the bond markets, but it won't be a disaster.
So you see negative yields then being just happening for the next X amount of years, or due to this innovation?
Flat to inverted, yes. I don't know. We have, back then, there was no Federal Reserve. The Federal Reserve didn't come into place until 1913. And there was little government intervention. So today there's a lot of government intervention, and especially on the monetary policy side. So it may not play out exactly the same as that, but we wouldn't be surprised to see much flatter and sometimes inverted, and maybe more than sometimes inverted over time.
I want to take a step back and talk.
Can I just, on the disruption of banks, it's not just the yield curve. It's companies like Square and PayPal that essentially are going to allow people to carry their banks around with them in their pockets through their cell phone. We've already seen mobile payments explode in China. They went from $1 trillion in 2014 to $26 trillion, 2 times their GDP in 2018. That's a 26-fold increase over 4 years. That's crazy. That's disintermediating the banking system in China. We think the same thing's going to happen in the developed markets, and that digital wallets will take the place of bank branches. And we see this with Venmo, and with Cash App. And these are networks that are going viral because of social networking. To give you a sense, Cash App, Square's Cash App, merchants use it. It's just entered Australia, by the way, and merchants can swipe the Square, swipe a credit card through the Square for payments. And payments will accumulate in the Cash App. And what Square's competitive advantage is to a bank is Square knows every second of the day how this merchant's business is doing, right? Because it sees every payment. And it's able to anticipate working capital needs. And it's able to anticipate maybe capital needs. Oh, and by the way, payroll processing. And then it's got consumers using it, right? And then these consumers the consumers are responding to Cash App Friday or Super Cash App Friday, when Square is giving away, maybe in conjunction, this did happen with Burger King, they'll repay $10,000 of school loans if the winner is chosen. I mean, if whomever is chosen. So of course everybody starts applying for the Cash App. They would like to have access to that opportunity. Same thing with Super Cash App Friday. They were giving away 1 Bitcoin. That's $10,000 these days. That caused another surge in Cash App applications. So their cost of customer acquisition is roughly $20, whereas a bank, to get 1 credit card customer, has to pay anywhere from $300 to $1,500. There's no comparison. It's going to be very difficult. And then, so you've got Square and Cash App and PayPal nipping at the bank's heels. You have Goldman Sachs, Marcus, their online banking solution, coming for the head of the banks, or the heart. They're offering 3% plus for online deposit accounts. They'll pay 3%, and banks are at 0.2 or 0.3 or wherever they are. Again, no comparison. Bricks and mortar, it takes a lot to sustain those. These are online, digital, much, much lower cost.
So if you look at that in the Australian context, obviously banking is such a huge part of Australia.
Yes.
Do you see then the end of traditional banks in sight?
Well, I don't know how your regulators are going to try and protect the banks. It could be they do, because they feel it's such an important industry. So I don't know enough about how your regulators feel about innovation and how they're reacting to it. I think it's hopeful that they've allowed Square into your country, and I think that's a very good thing, right? But I do believe that banking is going to be commoditized. I mean, we're seeing that happen right now. It's already gone through tough times, and I think it continues to go through tough times because of fintech and inverted yield.